Welcome back. Well, the final budget for 2024-25 will be presented on July 23rd. To decode what are the key expectations in the infra space, we have with us Ashish Modani, Senior Vice President and Co-Group Head Corporate Ratings at ICRA, as well as Ankita Shah of Elara Capital. Thanks a lot for joining in, lady as well as gentlemen. Well, Ankita, I want to come across to you first. Before we get to the expectations on the budget, you track Concord, and those numbers look a little bit disappointing. That was one of the top losers on the downside. A quick comment on that. How disappointing were the numbers, and what are you working with for this year?
Yeah, so Concord reported 3% growth on the EXIM side and 15% growth on the domestic front. Now, this is lower than the management guidance expectations that were set. They were targeting a 25% growth on the domestic side and 15% growth on the EXIM. We see overall port volume growth also being muted for the quarter gone by. Even if you look at container volume numbers of the power. And for Adani Ports also has been muted. So I think that has had an impact on the EXIM numbers of Concord. But we believe this could pick up in the second half of the year, given that GNPT is expected to get connected in the second half of the year. And Concord could be a beneficiary because they have nearly 70% market share at GNPT. And there the rail coefficient is low at 18%. And post the DFC getting connected, the expectation is that the rail coefficient will jump double to 30%. So obviously the larger market share beneficiary that is Concord will definitely benefit out of it. So I think the growth will pick up from second half.
Okay, all right. So past quarter was disappointing, but you're saying that going ahead, you have various triggers in place where things will improve. All right, so that's about Concord. Let's focus on the infra space then. Hi, Ashish. Good morning and good to see you in. Ashish, I wanted to ask you about the railway space. You know, from a stock market perspective, a lot of stocks have been doing well, anticipating better times. From a stock price point of view, maybe majority of the good news is in the price. But in the near term, the budget is going to be important. So give us a few numbers that we should be tracking in terms of railway budgets. You know, what were they? How do you expect them to pan out?
If you look at the last interim budget, the overall hike that was there, that was pretty modest. But if you look at it in isolation, it looks modest. But if you compare it with the FY22 level, last FY23, it was a bumper hike, around almost 50% plus. So if you look at it in the totality over the last few years, the share of not only railways and roads, both of the segments has increased substantially. And given the focus of government to reduce the logistics cost and ease of doing business, there is a lot of impetus on the railway as well as on the road segment. So all the entities in this two specific space, transportation space, are expected to do reasonably better than the other segments over the next 2 to 3 years. And what we are also expecting is regarding the freight related thing, with DFCC now becoming fully operational. So a lot of activities are happening now. The government is also talking about multiple other dedicated freight corridor while still in the progress, and it will take some time for them to capitalize. But in the interim, what we are expecting in the railway pies is on the wagon space. Wagon players are sitting on a very strong order book, and they are expected to do very strong in the next 2 to 3 years.
Okay, morning both of you. Ankita, now, you know, so at the margin, right, and markets, of course, move on incremental news flow. At the margin, expectation is that because over the last 4 or 5 years, spends on infra has been so strong, and now there is a bit of a change in terms of government. Maybe it'll be a little different. It won't be business as usual, etc. Actually, even in the interim budget, if you saw allocations, if you looked at specific sectors like roads, etc., the growth was very, very moderate. That is FY25 BE. Do you expect anything different when we get the full budget, specific infrastructure sector allocations, or do you think they'll be around or in line with what we saw in the interim budget, which was moderate increases and sharply lower growth as compared to 24 over 23 or 23 over 22?
So we expect the growth could be higher than what was put out in the interim budget. Reason being, the government has had very robust tax collections plus dividend from RBI. So there could be a midway between fiscal consolidation and the capex push that the government will go ahead with. So we believe there could be a uptick in the capex numbers that were announced in the interim budget, because we need a clear roadmap for our economy to become the third largest and USD $5 trillion economy. So for that, we need the required capex push, not just in roads, but railways, airports, urban infrastructure, energy sector, and along with it, sustainable development infrastructure. So I think there will be new sectors.
Okay. And do you think stocks need a higher allocation because stocks have done well across these sectors, right? So if budget has to be a trigger, the absolute allocation has to be higher than the interim budget for each of these sectors? I mean, for stocks to do well from here?
I think stocks are already pricing in the expectation of a growth. And that is why, despite order inflows not being very strong in the FY24, like previous year, because of, the elections and, model code of conduct and, those things, but already the market has started discounting on the expectations of higher order inflows going forward. So I think that should now flow down into numbers and actual inflows coming through for companies. So I think there will be earnings upgrades that will be coming in now. I think the PE re-rating has already started.
Okay, all right. Interesting. PE re-rating done, but now earnings upgrades is something that we look forward to. Ankita, any numbers you're working with that we should be looking forward to in the budget?
In terms of
allocation,
growth,
in terms of allocations, budgetary announcements that you are working with, that you have already penciled in. So then we have, a reference point when those numbers do officially come out.
No, we do not have exact, numbers put out, but we expect it to be higher than what it was announced during the interim budget.
All right. Any percentage, how much higher, or you have not yet worked on that?
No, we have not put out on those numbers.
All right, Ashish, I want you to comment then. If in case we need to be tracking a couple of crucial announcements, which would be your top 1-2 pointers that you're looking forward to in this budget, and what could it mean for the industry?
See, our house view is that ICRA, we are expecting that overall capital outlay will remain more or less at a similar level what was highlighted in the interim budget. Because if you look at April and May, it was already down by almost 14% year on year, that 2 months combined. So, and monsoon, that quarter 2 is generally a lean quarter. So a strong ramp up is required in quarter 3 and quarter 4 to even meet the interim budget estimates. So we are not expecting a meaningful change in the capital outlay, but there is around almost 70,000 crore buffer that is allocated in the new schemes, which can be reallocated between various ministries. So that is something that we really need to watch out for, how this 70,000 crore will get allocated. Because if you look at the delta from FY24 to FY25 budgetary estimate, out of 1.6 trillion rupees, 0.7 is coming from this new scheme itself. So how that will get reallocated, that is something we want to see. But we are not expecting a material change in the overall capital outlay at ICRA.
Okay, all right. Ankita as well as Ashish, thanks a lot for joining in and filling us in with your expectations with regard to the budget. We look forward to touching base with you all and see how, what the announcements come and what were you all expecting, what's the deviation out there. But for the time being, thanks a lot for joining in.